Hello guys, welcome. This is Ali. In this video, I'm going to be demonstrating and explaining one of the important tools available to you as a footprint trader, which helps you tremendously with your daily trades and allows you to become much more profitable while trading using the footprint chart. So without further ado, let's get to it and learn this tool. So guys, I'm pretty sure you've heard the term divergence in your trading life. And divergence happens whenever you have the conflict between the price and the indicator that you're using. Okay, for example, the indicator is making a higher high at the same time the price is making lower high. Okay, so there's a conflict between the indicator and the price. Okay, so inside the NinjaTrader platform that we're using for the footprint chart, okay, you open up your chart, you click on this indicator icon at the top. Okay, give it a second to load up because I've already loaded too many indicators. There you go. Go into the middle of it, and you're gonna have this tool which is called order flow cumulative delta. Double click on it. Don't change anything. By default, add it to your chart, and will be displayed at the bottom of your chart here. And this is the cumulative delta indicator. Okay. So before we get into the examples, I'm going to show you the types of the divergence that we have. Okay. This is the first type. Market is making lower low at the same time the price makes higher low. Okay. You see the market makes a lower low. We have a downward momentum, but at the same time the price makes a higher low. Ultimately, the price follows the lead of the underlying indicator. So this is the bullish trend reversal signal. Okay, it tells you that the market is gonna go up. If it's going down, it's gonna go up. The second type is called bearish cumulative delta divergence. Happens when you have the price making higher high at the same time the underlying indicator makes a lower high. Ultimately, the price follows the lead of the indicator and it goes down. So it changes from bullish to bearish. So it's again a reversal signal. Okay. The third type is called hidden bullish cumulative delta. When you have the underlying current trend which is bullish, it is a continuation sign. Okay, market is making higher lows and the general trend is uptrend. Okay, the market is making higher lows. At the same time, the underlying indicator makes lower low. What happens later on is that the price continues to go up and the indicator catches up with the trend, with the price. It goes up. So this is the continuation signal. Okay. And the last one is this. The market is making lower highs, right? At the same time, the indicator makes a higher high. Ultimately, the indicator follows the path of the price and it catches up and goes down. You see? Boom. So we have four types of divergences which you need to commit to your memory, okay? Because you're going to be see them on your chart. Let's go to live example. These are the trades that I took today on gold and I love them. Okay, huge pips, huge profits, and was great. Let me show you how did I took them. So earlier this morning, by the way, this is the 5-minute chart of the gold. Okay, and earlier this morning, 4 bullish candle, it took the price from this one all the way, it took the price from this point all the way to the top. Okay, it rallied up. I was not able to catch this move, but I was able to catch the move to the downside. Let's take a look at this. Market moved down a little bit. Okay, pushed back up, made a new high. But at the same time, look at this cumulative delta indicator. You see, cumulative delta indicator makes a lower high. Price makes higher high. What type of it is this? Here it is. Bearish cumulative delta divergence. Price makes higher high. At the same time, the indicator makes a lower high. What happens? Price follows the lead of the indicator and goes down. Here it is. It went all the way down. I took this short trade, and let me show you how did I take it. There you go. So take a look at this candle. Okay, we have decent volume going out inside the market. Okay, 3200, 5200. But with this candle, something interesting happened. Candle closed bearish. Okay, it closed below the POC. Okay, POC, the prominent POC, the place that the most of the volume transaction took place between the buyers and sellers. It closed below that. Not only that, it closed below the value area. Okay, I have stacked imbalances at the top. Okay, despite having too many stacked imbalances at the top, yet the price couldn't close at the top. Okay, closed at the down here. Okay, below the open price even. Okay, seeing this, I knew it that the price was going to continue to the downside. So what I did was that I took a short trade right at the opening of this candle. I put the stop loss a couple pips above this one, and ultimately the market moved down. Okay, it was a great trade, and I closed the trade right at here. This was the opening, this was the initial move of this trend, and I just closed the trade here. Huge profit, huge gain out of this trade. Okay, the second example happened a couple hours ago, and let me show you where did I take that trade. There you go. Look at it. The market is going down, making what? Lower highs. You see? Lower high. At the same time, the cumulative delta is making higher high. What type of a divergence is this? Okay, let's see. This is the hidden bearish cumulative delta divergence. The market is making lower highs. At the same time, the price makes higher highs. Ultimately, the price goes down, okay, and the indicator follows the path of the price and it goes down with it. You see, boom. Okay, market goes down. I took this trade also, and let me show you how did I take this trade. I'm going to zoom in here. So here it is. The market was going up with decent volume, 4,200 contract, 2,200 contract, like a 2,000 contract. So it was going up. Okay, we had decent volume. Okay, but something interesting happened with this candle. Just like the previous example, the candle closed below the opening. Okay, closed below the POC, but was inside the value area. Okay, look at the top of the candle. I have single print. Only one contract got traded at the top. You see, only one contract. No interest was there. Okay, only one contract got traded there. And I have a stacked imbalance at the top. Price yet closes there, bottom, almost toward the bottom there. So I knew that the market was going to go down. Okay, the general trend was downtrend. Okay, this candle closed, gave me indication that the market was about to go down, and I had the confirmation of cumulative delta divergence. So they all gave me the confidence that the market was going to go down. So I took a short trade right at the opening of this candle. I put the stop loss just 5 pips above this one. As you can see, the market went crazily down, and I exited here. Now the market is inside the range after that. Okay, it hasn't moved that much. Okay, so guys, I had 2 great trades today with the privilege of the cumulative delta indicator, and I thought to myself, why shouldn't I share this with people? Now after watching this video, you know what this tool is and how to add it to your chart and how to use it. So don't hesitate and start using this tool. So I hope this video was informative, and thanks for watching. Stay tuned for more. Bye.